Welcome to the Cash Stream Financials video, an introduction to acquisition finance. In this video we will explore the different structures of acquisition and how acquisition finance fits into the process. My name is Tim Lee and I'm the CEO and founder of Cash Stream Financial, specialists in raising working capital finance. I'm also the author of a book entitled The New Bankers, which was published in the UK. You might be interested to know that this video is part of a series of videos relating to commercial finance which are available to view in the Learning Centre of our website, cashstream.com.au. So let's get started. Why do companies acquire? On paper, acquisitions make sense for a variety of reasons, and on the screen there are a number of typical reasons as to why companies acquire. These might include increased market presence, entering new markets, acquiring new technologies, etc., etc. Whatever the reason, they all generally make sense before the event. But how successful are acquisitions? Formalized research is quite rare, but the consensus amongst most commentators and anecdotal evidence is that most deals don't deliver. Business Week at Mercer Management did a report of all acquisition activity between 1990 and 1995 in excess of $500 million, and they concluded that only 17% of acquisitions generated substantial returns for the acquirer. If we turn this round, this means that 83% failed to generate substantial returns. So if the large players get it wrong, why should we as SMEs be any better? The key thing is that acquisitions are risky, and this is why financiers are cautious. Okay, so you found your acquisition target. How do you structure the acquisition? The structure of acquisitions plays an important part in how it can be financed. And there are two key ways in which acquisitions are structured. Firstly, there's asset purchase. Secondly, there's share purchase. An asset purchase is where the assets of the business only are purchased. For example, plant and equipment, property, trademarks, etc., etc. In this structure, in most cases, debtors and creditors are kept by the vendor. Under a share purchase scheme, on the other hand, all assets and all liabilities are taken on by the purchaser, even the hidden ones. And this is why purchasers normally require warranties from the vendors that there are no hidden liabilities being taken on board. So how much are you going to pay for your acquisition? The value of a business is the price somebody's prepared to pay for it. And whilst there are formalized valuation methods, for example, discounted cash flow, etc., etc., by far the most popular is a multiple of EBIT. And EBIT are the earnings before interest and tax. Now that EBIT figure may be normalized, where various costs might be added back, for example, redundancy costs, one-off marketing expenses, etc., etc. The multiples of EBIT vary from industry to industry, typically dependent upon demand and the growth potential. For example, traditional textiles, where there's very low demand, might command 1 times EBIT, and financial services might command as high as 10 times. A large portion of the value of any business is the value of its goodwill, an area that needs to be considered carefully. Essentially, goodwill is the purchase price in excess of the net asset value. And goodwill represents the elements of the business required to generate ongoing income. For example, strategic relationships, technology in place, etc., etc. So why is goodwill important to acquisition finance? The answer is simple. Unlike other tangible assets, lenders attribute nil value to goodwill and will not fund it. Goodwill is normally funded either by your own equity or by the purchasers in the form of some form of vendor finance, which we'll consider later on. So let's see how acquisitions get funded. Well, the key sources of funds are: number one, the internal funds of your business, for example, historic profits. Although it should be obvious, you should never fund an acquisition through the working capital of your business. Second is equity. And external sources would be typically angels, and there are a number of angel networks around Australia. Venture capital firms. You might want to have a look at avcal.com.au, which is the Australian Venture Capital Association, for details of venture capital firms, and private equity organizations, although they tend to focus on larger transactions. The third source is debt. The traditional banks are an option, but they will require traditional security, property and business assets. There are specialist lenders like factoring houses, invoice discounting houses, inventory financiers that can all advance additional cash against specific assets. You've got the asset-based lenders that take a holistic view of the balance sheet but closely manage each of the assets to advance more money than traditional banking. And the final part is vendor finance, where the vendors of the business take part of the consideration for the acquisition on a deferred basis. This normally applies when the vendors stay within the business. One thing to be mindful of is the possibility of a ratchet being placed on the vendor finance, such that if EBIT does increase, the value that you pay to the vendors increases also. So let's have a look at some debt structures. The first thing to notice is the structure of debt funding depends upon the structure of the acquisition. An asset purchase is easier for debt funding, as assets can be easily ring-fenced and valued. Under a share purchase acquisition for debt funding, these can fall foul of the Corporations Act, Section 256, where a company is not allowed to use its own assets to purchase the shares of a business. Now, there are means and ways of getting around this, and you should speak to your legal advisor and ask them about the whitewash process. Just be aware this whitewash process can delay the settlement of any acquisition.